There we go. How you doing, Yago?
Good, just setting up my microphone thing.
All good. All right, we got everybody here. Get this rolling. Yeah, everyone, thank you so much. Welcome to today's Sovryn Tea Twitter space. We're joined by Edan Yago, David Seroy, Mark Moss. It's a pleasure to be here and have y'all with us here, our guests. Yeah, so let's get rolling here. Mark, it's funny, we haven't properly met, but I saw you at Bitcoin 2022. I was interviewing a woman. She saw you running by and she immediately started shouting your name, Mark, Mark. Came over and gave her a quick hug. I think we're supposed to meet you, but like our schedules didn't align with all the hustle and bustle. But anyway, thanks for being here.
Awesome. Thanks. Yeah. What a madhouse that place was with whatever 30,000 people. It was craziness, but good times though, for sure.
It
I
was.
can't wait. I can't wait for this year's or next year's, I should say, I guess.
They always top each other, don't they? Who knows what's next year's going to be, huh? So, yeah, anyway, so the title of the space is Will Crypto Fallout Lead to a Bitcoin Standard? I saw your tweet earlier, Mark. I'll start with you because I saw that you wrote on Twitter that crypto won't see another bull run and how this will probably speed up a move towards a Bitcoin standard. Can you expand your thesis on that to start?
Yeah, I got some feathers ruffled on that one for sure. So let's unpack that. It needs to be unpacked because there's a lot of nuance into that. But yeah, I'll unpack why I said that and why I think cryptocurrency as a category won't see another bull run. All right. So as a category, and when I say as a category, I mean as you generally call crypto. When you say crypto, you're lumping all crypto assets in there together. Now, Bitcoiners, we say Bitcoin, not crypto. Not that Bitcoin is not a cryptocurrency, but when we're talking about Bitcoin, we're talking about Bitcoin. When we're talking about crypto, we're talking about crypto, but not using the two together. One of my favorite analysts, Lynn Alden, says that to conflate Bitcoin and crypto shows you misunderstand both. And so they're separate. So crypto as a category, not having a bull run, sort of like we saw in 2017 or we saw in 2021. And so why is that? Well, first thing you have to do in order for, I should make clear to understand this thesis, is you have to understand how crypto as a category works. Most people don't really understand that. So we got to start there. So Sam Bankman-Fried actually laid this out perfectly in an interview, I believe in May of this year with Joe Weisenthal, and I forget who he was talking to, but he basically said, if some of you guys saw it, they were asking him to explain this, and he said, well, let's say that you create this box, and this box is, I don't know, some world-changing protocol. And then the next step is you have these developers create this box token. And then you get these market makers that trade a thin amount of these tokens to give it a perceived value. This is his word. So these are market makers like Alameda manipulating markets by thinly trading tokens to give it a perceived value. That was his word. Then he goes on to explain that once it has this, once the public perceives it to have value, then they will start to trade it. All right. So that's how cryptocurrency, the crypto market works. He was specifically talking even more specifically about DeFi overall, but for the most part, that's how crypto works. And so we know this to be true. I think all but about 5 tokens were pre-mined and sold. So a group of developers built a project, got a bunch of tokens, and dumped them onto the market. All right. So that's how it works. He said it. That's how it works. That's fact. Now, if you understand that to be true, then you can understand why there's so much hype, why there's so much money, why these bull runs happen. And so typically in technology, so people say, but Mark, you don't understand. Regulations can't stop technology. So they look at these cryptocurrencies as this new technology. So typically with technologies, if they've been coming out of Silicon Valley, I'm here in California, so I have a kind of a close connection to that. And so technologies come out of Silicon Valley. And if I was going to create a new technology, a new app, that did some cool new payment thing like a Venmo or some new ride-sharing app like an Uber, for example, I would have to go to real investors and I'd have to give them a real business plan and they would have to give me real dollars or money back in order for that investment. But more importantly than that, these investors, these venture investors, these venture capital investors, well, typically you would go through like a friends and family round, then maybe an angel round, and then eventually you get to a VC round. And the venture capitalists, they typically start up funds and they'll pool money and they'll typically split that between a
Is it just me or did we lose Mark? Oh, never mind.
You don't hear me? Can you hear me?
Sorry, it's good now.
Okay, sorry.
Might have just been on my end.
Sorry about that. Okay, so a typical VC fund has about a 7 to 10 year lockup. So I run a fund. I'm an advisor for another VC fund, Trammell Venture Partners, TVP. And so when people put this money into the fund, they know they don't get that money out for typically 7 to 10 years. And the reason why is because you have to allow these companies to have some sort of liquidity event. So back to Uber as an example. I pitch you on Uber, you decide to invest into it, you lock your money up, and you don't get your money back unless there's some sort of a liquidity event, which is either a sale or they go public, right? Then you get your money out. That's the way VC works. Now, cryptocurrency is a regulatory arbitrage. So they're trying to get into this little bit of a gray area where they're basically doing the same thing, but they're trying to skate past regulations. And so VCs love this. Now a venture capital, A16 or fill in the blank with whatever venture capital firm you want, they can come in, they can put their money into this new technology company, so to speak, and they immediately get tokens, maybe 30% of the token issuance at say 3 cents or 6 cents or whatever the valuation is, and they can turn around and dump them right onto retail for 9 cents or 12 cents or 26 cents in some cases. So of course, venture capital loves this. They've never been able to get into these early stage companies and have an immediate liquidity event. And so of course, more VC, more CD, more money, more money, more money. With more money comes more hype. With more money comes more media. With more hype and media comes the Mr. Wonderfuls of the world. Massive amounts of money spent in advertising, Super Bowl ads. As a matter of fact, since the cryptocurrency market has crashed, advertisers have lost 6% of their revenue just from cryptocurrency advertisers. So all this hype, all this media attention, all these celebrities coming in because they love this. They've never had an opportunity to get these VC investments where they can instantly dump on retail. Now back to Sam Bankman-Fried's interview, he says, so we trade it where it perceived value, and then the rest of the public wants it. And so the rest of the public sees this. Oh my gosh, Mr. Wonderful. Oh, A16, all this money, hundreds of billions of dollars. Oh, look, they're running ads. We're going to come in and start trading it. But the whole thing was kind of set up sort of like a scam a little bit. Okay, so that's how it works. Now, why would I say it won't see another bull run categorically? Well, I believe that the SEC has been angling to start cracking down on this. Why haven't they? That's a whole different conversation. But at this point, the SEC has one job, and that job is to protect consumers. And they do a horrible job at it. They never do a good job with it. However, they have done, and they've completely failed. Obviously, millions of Americans have lost everything. Billions of dollars are gone. They didn't protect consumers, and they look horrible. In my opinion, they should shut down, pack up shop, and go away. In my opinion, we don't need them anyway. If I can invest my money, or not invest, but I could buy lottery tickets, or I can gamble my money, I don't need a regulatory body to protect me or tell me what to do with my money. So I would be happy just to see them go away. However, their job is to protect people from losing money. They failed. So now they have egg on their face. They have to act. They have to do something, and they're going to. Gary Gensler's been ramping up his rhetoric. We have people on top of Capitol Hill calling for regulations. Of course, Senator Elizabeth Warren and Maxine Waters are submitting new types of regulations. And so all of this is coming down. They have to do something. And we could even talk about why I think FTX might have been a big psyop just to even push the regulations through. Of course, Sam Bankman-Fried was taking all of this money he was stealing from people, using it to go get chummy and buddy-buddy with all these regulators to create new regulations. And so now a lot of that's coming through. I believe that will come through. And when it does, they're going to crack down on this regulatory arbitrage. And they're going to force these tech companies, these cryptocurrencies that are new tech, to go through the traditional tech path, which is go raise your money with your friends and family and your angels, and then register as a security and do an offering. And so when that happens, then I believe the crypto bull run is over. And the reason why is because venture capital loves these crypto assets, as I said, because they can have instant liquidity. But when that instant liquidity is gone, and now a crypto company is going to be forced to go through the entire registration process. First of all, right off the bat, most of them won't be able to do it. It's very long, very arduous, and it's very expensive. So most of them just go away right off the bat. The ones that do manage to try and go through it then have to go through a whole process, including disclosures. Imagine if Ethereum was going to do disclosures. Like, there's just no way. They're going to disclose every single token, who bought what insiders have what the relationship is between the Ethereum Foundation and Joseph Lubin, and who has control. I mean, there's just no way they're going to go through those disclosures. And if they do, people and regulators probably aren't going to like that. So it's gonna shave off most of the industry just like that. And then ultimately, the ones that do make it through that filter, venture capitalists, as well as you and I, the public, we're now going to be able to look at this tech company versus another tech company. So now cryptocurrencies are payment networks. Oh, but Mark, you don't understand. DeFi is peer-to-peer lending. Okay, great. So then we'll look at it compared to peer-to-peer lending companies. And now we'll be measuring these on a more apples-to-apples basis. And I think, again, that continues to just weed this off. So that's why I said categorically. Now, some of the pushback, I'll just throw out a couple of pushbacks before we get into some of these questions. Some of these pushbacks are, Mark, you don't understand. If they push these regulations, they're just going to go offshore. Sure, of course. I don't doubt that. So they're going to go to some small, tiny little offshore jurisdiction where the long arm of the United States government and the ECB and Euro and Japan, they don't have regulations. So they're going to go to that small little jurisdiction. Sure, okay, maybe. but the U.S. venture capital firms sure as heck aren't going to follow that. The money's not going to follow that. The media and the hype is not going to follow that. Right. And so, sure, maybe it'll happen. But as a category, I think the days are numbered.
All right. Yeah, quite definitely a comprehensive response right there. I can appreciate that. Edan Yago, David Seroy, do you guys have any thoughts on what he's saying? Do you agree with his thesis in this regard, or maybe do you diverge at any point?
Well, I don't think it's true that that's what we're going to see. I think it would be lovely if we were able to purge ourselves of scams and low quality projects and obvious projects that are looking to just arbitrage the opportunity to grab some money off of hype. But I don't see anything that's fundamentally changed or is likely to change. So when the last bubble, which occurred before this one, so
hang on before we go into that, just that last statement, you said you don't see anything that's fundamentally changed. So you don't see So then I guess what you don't see fundamentally change is you don't see that there's increased scrutiny on these regulators and they're going to step up regulation. You don't think that's going to happen? Is that the part you don't agree with?
So I think they may. I struggle to see what regulation they will introduce, which is going to fundamentally change the dynamics here.
Well, so for example, if they say, just like the library case that just went through, where they said they argued, hey, but it has utility, and the judge says there's no triable defense. This is a security, plain and simple. So if they do that, Gary Gensler has now said that he believes that the top 5 cryptocurrency exchanges should all register as security exchanges. And if they did that, they'd have to delist most of the tokens. So you're saying that you don't think any of that will happen? There won't be increased regulation?
I think that might happen. And I think that would be extremely interesting to watch happen. And I think that would be an unmitigated boon to Bitcoin and cryptographic property. If we could eliminate the middlemen, that would be a phenomenal result. But do I think that will mean that more tokens are not issued or that there isn't an additional hype wave? No. And the reason is that the regulatory arbitrage opportunity, that window isn't going to close. And in fact, that window is only going to expand. So you argued that these efforts will move offshore to some kind of small cockamamie jurisdiction. And I don't think that that's necessary for them to do it all. I think there is the entire crypto space which they can move into. There's no reason to set up a company. There's no reason to present themselves as, to even have people standing behind projects. Projects can be launched by protocols. Project can be launched in either deeply obfuscated ways or actually decentralized ways. And I think it's very, very difficult to stop that. I think we're in a period of time where we are moving from a society which has been weaned off of capitalism and property rights for the last 150 years in a gradual process. There's been more and more restrictions around what people can do with their money. And as a result, people are not used to managing their money and are only used to investments being made available to them once they've been through some kind of vetting process like you've described. And now, if Bitcoin is successful, if the idea of cryptographic property is successful, people will have this unmediated access to investment opportunities. The technology does provide, and I think will continue to provide, that kind of regulatory escape or arbitrage. And I think the waves that we're seeing of speculation, hype, and uneducated, uninformed YOLO investing only changes when the dynamics that are driving them change. And so that is, on the one hand, people becoming more used to the idea that they need to do their own research and vet opportunities themselves because there's no one hand-holding them or protecting them. And on the other hand, that people feel less desperate about their economic situation, their economic lives, and don't feel like their only opportunity to get into the property ladder, and I'm talking here about the property ladder, broadly speaking, not just real estate, is some kind of YOLO activity. And to that point, right, crypto was only part of a bigger show of massive overvaluation of Tesla, meme stock trading, Wall Street bets Reddit. This is all part of the same YOLO capitalism, which is the dying throes of the fiat system as I see it.
So I would certainly agree with that last part there about the YOLO for sure, right? And so I reference quite often Vladimir Lenin from Russia, 100 years ago, who led the Bolshevik Revolution, and all those people died. But he said that the best way to destroy capitalism would be to debauch the currency through inflation. And through a process of inflation, you could confiscate arbitrarily, right? So this inflationary process that we've had in the currency has created this, right? And he goes on to say at the end that through inflation, all relation to money will be lost until it degrades to the point where the only way or the best way to get rich is through gambling and theft. And so that's where we're at, right? We're at the end of this long-term debt cycle. So I agree with all the things that you said there. And so as he predicted 100 years ago, the best way to make money today is gambling, YOLO, or theft, SBF, right? And so that's where we're at as a society. And so kind of to the points that you're making, until we get back to some sort of a better system, people are still going to try to YOLO. They're going to gamble or they're going to steal. That's it. And show me the incentive to show the outcome. But I would say if we roll back, and I think the key pieces, I think we don't want to gloss over them, is, again, back to my thesis. So nothing fundamentally changed. Well, something fundamentally changed is that there's massive pressure on government and policymakers and regulators to do something. They've already been wanting, not just in the US, but also the ECB's cracking down really hard. So governments don't need any more excuse to crack down. They've been holding back maybe because of the people, but now the people are demanding it. So we could talk about maybe, was this some sort of a psyop? But a lot of times you have things maybe called like false flags that might garner public support to push certain things like take away free speech or take away gun rights or things like that. And so maybe the governments have already wanted these regulations and now they're getting the public support to actually put those through. And so I think those are coming. Now, you said, but projects could still launch tokens in a decentralized way. It's hard to stop it. And so that's what you said. So if, and this is a big if, right? I mean, obviously I'm speculating, we're all speculating here. But if we get increased regulations, which seems the more probable case to me at this point because of the situations we have, if that happens, Will it stop these tokens from launching in a decentralized way, like you said? Certainly not, right? And so tech companies are still going to create tech. It's not going to stop. They just might have to go through a different process. And really, the process that's problematic is the token offering. The token offering is what gets them in hot water. Creating protocols, creating software, people do that all day. No big deal. It's the token that's the problem. And could they still do it in a decentralized way? Could they go to some obscure jurisdiction and do it through a decentralized exchange? So they certainly could, and most likely they will. However, they won't have the hundreds of billions of dollars in VC money, the hype machine, the marketing, the celebrities with it. And so, sure, just like you mentioned Tesla going up, and it's part of the YOLO society, I agree. And sure, you see Tesla pop, or you see GameStop pop, and ones and twos pop, and some crypto assets will still pop as well. I'm just talking about categorically, like we've seen in the past.
Sure. So, I mean, I think it's very likely that we'll see more regulation, and I think we'll see a more active SEC as well as other regulatory bodies in other places. And we saw that in the aftermath of 2017 as well. I think if you look at 2017, it's very instructive. It's instructive in at least three ways. First of all, VCs are relatively latecomers to this game. So Celsius is a great example. They raised, if I remember correctly, it was $22 million in an ICO in 2017. There was no VC participation. Gnosis raised $64 million. Bancor raised something like $150 million. There was no VC participation. And this was all possible when the total value in the crypto space, in Ethereum, in stablecoins, in Bitcoin, was much, much lower. So do we need this VC money in order to drive the next bubble? I'm not sure. The second way in which it's instructive is that in the wake of 2017, 2018, they went after XRP, they went after Kin, they went after, there were some very, very high profile cases and many, many smaller profile cases. And so in 2020, the market adjusted. And the vast majority of tokens that were launched on Uniswap. There was no pre-sale. There were what were called fair launches. There was the primary technique of yield farming, where a protocol gives away its tokens for free. And so there's no sale. But those tokens become tradable on Uniswap. And then early participants, insiders, founders, whatever, are able to sell significant amounts of that token. And so we've seen the pattern of the ability to do it without VC participation. We've seen the ability to do it without requiring centralized exchanges to participate. And we've seen regulatory backlash before. So one final point on this is the token sale itself the problem? And I would argue it isn't. And the reason I argue it isn't is the illiquid environment that startups have is in many ways a feature. And the fact that you have to go through all of these rounds is in many ways a feature, but it's also got significant societal bugs associated with it. The fact that only people who are already wealthy are considered accredited investors and then can have access to early stage investments has been one of the driving factors around the increasing concentration of wealth that we see in our society. One of the amazing things that made Bitcoin different was that it was available to everyone at the same time. And people who got in early had to go through 85, 90% drawdowns with Bitcoin. So there was a need for conviction. But these were people who, they were regular. Satoshi didn't go through a process of saying, look, I'm going to gate access to Bitcoin because it's in alpha and it's risky and I don't think everyone should use it. It was available permissionlessly to everyone. So the biggest feature of token launches, token sales, is that they represent non-government, non-state-backed, non-state designed, right, or secured or permissioned property that is available to everyone, and it is being taken advantage of, right? And so what we're seeing in crypto is this yin and yang of free markets. On the one hand, it provides access to everyone. On the other hand, part of that everyone are scammers and degenerates. And they're the ones who also get the most attention. And so I think if we want to have a society of free people, of sovereign individuals, we need, on the one hand, to continue to preserve access, permissionless access to everyone, but at the same time, we need a society that becomes accustomed to those freedoms and learns to live with them and learns to educate itself around them. And that is a very, very significant non-technological challenge.
So I mean, obviously we have so much to agree on. And that part right there that you're talking about is, of course, what I agree on. And I think that's one of the big differences between Bitcoiners and crypto people, is that we're just on two different missions. And so, you know, I'm on a mission to separate money and state, right? For all those reasons that you've talked about. Most crypto is trying to make more US dollars. And so the missions are just different, right? But I agree with what you said. Right, the problems that we have. I agree that accreditor investor rules are not protecting people, and as a matter of fact, they cause more harm. Right, now you have only the rich are able to get into these early round deals, and then they instantly dump on retail, and the prices go down on them. Right, so they don't actually protect investors; they hurt investors. And I'm certainly not here. Let me just make this clear. In the long tweet thread that I did, I put a video clip on there. To kind of back it up, but I'm certainly not here asking or advocating for regulations. I'm certainly not here asking for that. As I kind of made the case, I think the SEC should just shut down. If I want to put my money into lottery tickets or gamble it away in Vegas or buy DeFi tokens or whatever, I should be allowed to do that. It's my money, it's my property, and I have under the way that I see the world, I advocate for strong property rights, and it's my property. I should do what I want. So I don't want the regulations. I put a video clip of I was on the news desk with Mr. Wonderful and at the Bitcoin conference, because he was there advocating for regulations. He said, if we get more regulations, then the institutions can finally come in. And I said, hang on. You're a Canadian, so I get it. I'm American. In America, we're free. We don't ask for permission. Laws and regulations prevent us from doing things. Otherwise, we're free to do it. So I'm not here advocating. I'm just saying what I think is going to happen. And so while I agree with you, accredited investors and these regulations hurt people, they've created more inequality, societal wealth, as you said. I agree. It doesn't change the fact that what I see is just more regulations coming through. And again, we're speculating at this point of if that's going to happen or not.
No, I totally agree with that. So we agree on even more than you realize. I definitely think more regulations coming through. And I think that it is, you know, again, we're going to see this yin and yang. We're going to see the pluses and the minuses. So I think it's going to make it much more difficult for many Bitcoin businesses to operate. I think it's going to make it more difficult for Bitcoin businesses to get bank accounts. I think it's going to make it more difficult to provide custodial services. I think
that's where I might disagree. That's where I might disagree.
Go on.
Well, because remember, we started out saying when we talk about Bitcoin, we're talking about Bitcoin, we're talking about crypto, we're talking about crypto. So separating the two, I'm talking about crypto. Now, when we talk about Bitcoin, Gary Gensler was the head of the SEC. Before him, it was Jay Clayton. And Jay Clayton said very clearly that Bitcoin is a commodity. And now Gary Gensler has come out and reiterated, said Bitcoin only is a commodity. And if you look at the two, and you talked about this fair issuance of tokens, right? So you mentioned that. And so you mentioned how Satoshi didn't gate Bitcoin. And so Satoshi created code and released the code to everybody that was on the mailing list and, you know, in the forums at the time. And he didn't go mine or pre-mine a bunch of tokens. It was actually given to other people before he mined any. And the difference of a commodity versus a security is this: a commodity typically comes from the ground, but a commodity is something that anybody could go pull into existence. And no matter where you get, there's no common issuer. And anywhere in the world you get it, it's fungible. So I can go buy land in Mexico or California or wherever, and I could buy land and I could mine gold. I could go buy land in Texas or in Saudi Arabia, and I could drill for oil, or I could grow wheat or corn. And no matter where I grow the wheat, corn, oil, gold in the world, it's fungible. Everyone has the same opportunity. Go buy land, get the equipment, get the commodity, bring it into existence. There's no common issuer of wheat, gold, oil. Just like Bitcoin, the code is there. Anybody can get a computer, go mine on the network, and bring it into existence. And no matter where in the world you do it, it's fungible. As I said, I believe all but about 4 or 5 crypto assets were all pre-mined. Had some sort of an initial token sale or something like that. Now we get into the DeFi. We can talk about some of this later stuff. But when you look at the XRPs, the Cardanos, the Ethereums, et cetera, right? And so they had a common issuer, and so that's kind of where this hinges. And I know the Howey test, which they use to look at something as a security, is a 100-year-old law that was written for citrus farms. I get it, but if you look at just the 4 main points, you see, it's an investment of money. So when you type into Google, like cryptocurrency, investment is the main thing that comes up under. So people buy it to hope to make money. You talked about DeFi. They get the token for free, but then they hope to earn yield. So that's like an investment. They're hoping to get money back in a common enterprise. So is this a company, a group that's put this together? And more specifically, point number 4, to be derived from the efforts of others. So I hope that the Ethereum Foundation pulls this merge off, and I hope that their efforts don't wreck the network, and I hope that they'll eventually unlock my tokens and I'll earn my yield, so it's derived by the efforts of others, and 3, with the expectation of profit. And so I think we have that very clearly. Bitcoin doesn't have any of that, right? There's no common enterprise. There's no efforts of others, right? And so I think that's why I would just separate those two specifically.
That may be the case. I don't want to argue that point. I think it's a fairly nuanced question, where I think there's a broader question, which is, even if that is the case, do we think that on a practical basis there won't be collateral damage to cryptographic properties in totality, and that includes Bitcoin? The grandfather, the granddaddy, the center of gravity of the entire space. And I'd argue no. And I say this on the basis of several things. First of all, as a practitioner in the space, I've many times been engaged in either assisting companies or starting my own companies and trying to deal with the regulatory issues. Not long ago, I was the director of a regulated, FCA-regulated company in the UK, as well as a European regulated company. I have been working around the Bitcoin and banking space now for well over a decade. In 2013, I set up the first self-regulatory organization for Bitcoin as an effort to try and limit the impact of regulation. I worked with Kraken in 2014 on trying to get bank accounts and so on. Right now, what I'm seeing is that it's very difficult to get bank accounts if you're a new if you're an entrepreneur trying to start a new US company, for example. FINRA recently sent out a letter to all banks, literally every single US bank in the wake of FTX, telling them that they expect them to freeze all initiatives around crypto and Bitcoin for the next 3 months while FINRA introduces a review. So this has the noose is around Bitcoin as well. And so to me, the interesting question is, can we utilize this regulatory arbitrage to our advantage? And I would argue yes. I would argue that ultimately, one way or another, Bitcoin is going to be perceived and is already perceived and will continue to be perceived as a threat to the established financial order, as a threat to the BIS, as a threat to FATF, as a threat to the US dollar and to the Fed. And one way or another, the regulations are coming for Bitcoin and will continue to come for Bitcoin. There will be things like the travel rule introduced for Bitcoin transactions. There will be questions around custodial regulation. This will be not just Bitcoin, it will be stable coins, it will be everything. But it will be impact Bitcoin as well. And there's two ways that plays out. Either the entire space will suffer as a result. So there may not be another bull market. I don't think that that's very likely, but there may not be another bull market because everyone is too scared to come in. Or there will be another bull market, and it will be, Mr. Wonderful's wet dream, where only he gets access because it's only regulated players who can play. Or, and this is my hope, the third option, and I think this is the option that we want, is that we decentralize the layers around Bitcoin further. So it's not only cryptography and proof of work that we're relying on for decentralization, but it's also decentralization of the layers around it, the services, the on-ramps, the off-ramps, the convenience with which people are able to move in and out of these different assets, and most importantly, our ability to actually introduce full cycle economic activity around Bitcoin. We're starting to see that in places like El Salvador. I think we will see it more and more as things like Bitcoin-backed stablecoins or stable assets that can be provided to people via Bitcoin are introduced, and people can more and more move away from the fiat world and actually never have to off-ramp once they're in the system ever again. There's always going to be gaps in the system. Just today, Paxful and Ray announced that they were dropping Ethereum. But the reason that Paxful is such an important service is particularly because in places like Brazil or Nigeria or South Africa, it is a way where there is, even in countries where there's significant regulation, trying to make it almost impossible for you to use bank transfers to get Bitcoin. You can go and find someone, peer-to-peer who will sell you Bitcoin. And that's how I got some of my first Bitcoin. The first time I bought Bitcoin was from a guy in a wife beater who was roided out. His name was Tiny, and I was sitting across the table from him in a Panera Bread in San Francisco. Now that's not, I think, a mass market activity. But if we're able to continue to evolve, right? Paxful is a much better experience than local Bitcoins was 10 years ago. Stable coins already provide a much smoother experience as an alternative to fiat. And if we can decentralize the stable coins, that's a very, very thick layer of additional decentralization and protection that we have from allowing Bitcoin to fall into the clutches of regulators.
Yeah, still a lot to unpack there. We could dive deep into the whole decentralization of stablecoins, but that's a whole rabbit hole to go into. But I think to the point, a couple points that I would obviously agree with you on is one, the control over money, and control the food, you control the people, control the energy, control the economy, control the money, you control the world. And so, of course, that's always going to be, the target. We can see, the ECB, you talked about maybe potentially regulations on like the travel rule, for example, the ECB's been talking about. And now Elizabeth Warren is back on her IORs trying to put the new bill together that wants to lock in, KYC, AML into every single transaction. It probably won't go through, but they're going to continue to attack that. On another side, if you look at Bitcoin as a store of value, nobody looks at U.S. currency as a good place to store value, right? No one stores it in dollars. You store it in real estate, you store it in equities, you store it in bonds. And so they're not going to take away every store of value. And so, we can argue that. But overall, I don't know. It's a good conversation. I don't know what you want to do here with it next. If you want to bring up some speakers, I see some people in the audience that might be good to bring up. I see Bruce Fenton out there. I know he's been working with regulators and laws and kind of politics. Maybe he might have some insight into this, or looks like Shane Hazel as well. He was, on the Libertarian Party. Or what you want to do next?
For sure. Yeah, David, I saw you were trying to speak earlier. Did you have something to add to that subject that they're just talking about?
I think they did a pretty good job of summarizing it. I sympathize with both sides. Like, I think I definitely see, Mark's perspective that most of this is, grift and gambling. And I was kind of laughing, like when you were saying that Lenin, calls it this like YOLO culture. I'm just like, picturing him like screaming YOLO at the top of his lungs. But I also sympathize with Yago that there is this tiny subset of this kind of movement outside of Bitcoin that is not necessarily grift and not necessarily gambling. And I think it's this shining light of hope that we should pursue. And it's kind of the reason I wrote the paper I did. And I don't know if that's too much of a tangential topic. I'm happy to discuss it, but yeah, that's kind of my take on it.
Yeah, David, could you actually, FY Mark and company, David just wrote a piece for Bitcoin Magazine. It was the path to a Bitcoin economy, decentralized Bitcoin-backed credit. Did you want to offer your thesis in a nutshell?
Yeah, sure. I'll try to give the quick overview. I mean, the purpose of the article was to kind of map out what I see as a credible path forward to a Bitcoin-based economy. And so it kind of took existing monetary writings from people like George Selgin and Nick Bhatia and Jeff Snyder and Caitlin Long and a bunch of other people, and combined it with more recent technical innovations with things like DeFi and ZK rollups and Lightning Network and Taro. But if there was a singular central idea to the piece, it was this kind of ever-present argument of can and should a credible form of credit money exist in a Bitcoin-based world. And the punchline is essentially that I believe decentralized Bitcoin-backed credit and Bitcoin-backed stablecoins are really the key unlock that kind of addresses the concerns of all sides. Specifically how do we create monetary elasticity and stability, which is something that maybe Jeff Snyder and the free bankers would kind of talk about, but without deviating from this kind of core Bitcoin ethos of 21 million self-custodial, credit money leads to malinvestment and distortion. And I think there's this perfect world that kind of addresses all of those concerns. And going back to what I mentioned previously, it's like let's all just agree, yes, the huge majority of DeFi and all this other stuff is grift. But there's this tiny portion of it that is not this SBF going on odd lots and black box type thing. There's a way that we can credibly create, better decentralized solutions than some of the CeFi stuff. And I think something like what Sovryn's built with the protocol Zero, which allows you to borrow at 0% interest against your Bitcoin outside of a centralized intermediary, and as a byproduct, create a Bitcoin-backed stablecoin, is really a profoundly important product. And I think that we're naturally going to start see where people say, hey, I don't want to sell my Bitcoin. I want to borrow against it at 0% interest rate. And that's going to drive more liquidity into this Bitcoin-backed stablecoin market. And all these people who say, hey, I kind of like Bitcoin, but I live on $10 a day and I can't handle the volatility, will say, I need, dollar stable coins, and I'd rather have a censorship resistant one that doesn't require KYC from a bank. They're going to start demanding more of these Bitcoin-backed stable coins, which in turn is going to drive more collateral back into minting more stable coins. And I think a lot of this stuff is naturally going to start happen. It's not going to be this whole theory where everybody's like, oh, bro, please, dude, please, just use my DeFi protocol. Please, it'll be so great for Bitcoin. I think we're going to naturally start seeing this world start to arise, and it's going to allow Bitcoin to be the kind of pristine, pure collateral store of value 21 million, while simultaneously creating these kind of credit creation and monetary layers that, frankly, are essential to a modern day economy. And that's kind of the purpose of the piece. I'll pause there because I don't want to get too lost in the details, but yeah, that's kind of how I see things playing out.
Cool, good stuff. Mark, did you have any comments on that, or else we could go into audience questions?
I mean, there's a whole rabbit hole to go. That's a whole another conversation. I don't know if that really ties into the original purpose of this space, which was why I think cryptocurrency as a category won't see another bull run. I'm happy to have that conversation, although we might want to get some better Austrians on than me to kind of explain how Mises, broke down the difference between circulation credit and commodity credit, and kind of explain that. But again, I think that's probably better off spending another hour on a different space. But I think, like Yago said, I mean, we definitely agree on a lot more than we disagree on. And I'm not saying that innovation and technology goes away. And maybe some guys will still be tinkering and do some fair launches of tokens and protocols, and maybe they're not all scammers or whatever. But I think my point still stands as a categorically. I think cryptocurrency has seen its last bull run. I would just finish to say that I think it's extremely bullish for Bitcoin. I understand all the headwinds that it faces, as Yago pointed out, with potentially new regulations, problems getting bank accounts, travel rules, banning private wallets, all those potential things that could happen. But ultimately, I think it's bullish because if you look at cryptocurrency, It can be looked at, Lynn Alden kind of pointed this out to me, as like a DDoS attack against Bitcoin, right? A denial of service attack, where instead of spam attacking a server and denying its service, you kind of have Bitcoin. And all of you guys get the emails. I get them all the time. I see the Medium articles saying the next Bitcoin, the next coin that can go up by 10,000%, right? We're flooded with that. And so the average person coming into the space, they don't really understand Bitcoin or cryptocurrency at all. They just want to try to make some more money. They want to YOLO into it, as Yago said, which is, I agree with, right? That's where we're at as a society. And so everybody wants to YOLO in, and 100% return isn't good. 1,000% return isn't good. They need 100,000% return. And so they want to find the next Bitcoin. And so at first it was 1,000, then 5,000, now it's 22,000 cryptocurrencies promised to get you, a better US dollar return on your money. And so most people coming in choose that. It's a denial of service. If, which I believe it will because of regulations, we take those 22 and knock it back down to, a handful, then a lot of that money, right, because prices move on supply and demand, Bitcoin being a fixed supply at 21 million. And so if you have all this demand coming in, but instead they go, oh, but I could go get this other small cryptocurrency that's the next Bitcoin to make a bigger return. And if that goes away, a lot of that money flows back to Bitcoin, which I think is extremely bullish. So I guess that's where I'll kind of wrap it up, and then we can go into some questions if you want.
All right, sure thing, guys. So audience, I saw a couple of people requesting earlier. Go ahead and request to be a speaker if you want to ask a question to the gents on stage right here. I'll give you a second, folks. So just go ahead and submit a request. In the meantime, I did have a couple audience questions that were submitted prior to the space. We're touching on it a little bit, but will nation states accept the wide-scale adoption of Bitcoin? Will they impede Bitcoin, hyper-Bitcoinization?
Well, the ones that have the least to lose will adopt it first, like El Salvador, right? So I think we'll continue to see more and more nations that have nothing to lose adopting it. And the ones that have the most to lose, specifically the US dollar, will be the last ones to adopt it. And so the bigger ones will try to co-opt it. And this is where the game theory comes into play, right? And so I'm bullish on that. I'm bullish on the game theory. And I think, as we continue to see these currencies blowing up, all the currencies are blowing up right now. It's the smaller, tier 3, tier 4 currencies right now, as I already kind of mentioned, the Turkish liras and the bolivars, et cetera. And those countries, they're going to have to make a choice. What do I go to next, right? Do I just, shut my currency down and move to the dollar, or should I try something different? And so I think we'll continue to see more and more. I think you have to look at a bigger geopolitical kind of picture as well. And obviously, the dollar has been losing its relevance globally for a long time. The big nations, of course, Russia, China, have been de-dollarizing for a long time. The confiscation or the seizure of Russians' FX reserves was a giant catalyst to this. And so if Russia can get their bank account seized, what chance does a smaller country have? And so I think game theory plays out small countries first, and eventually the big countries have to play.
Absolutely, you're on this end for sure. Brad.id, you can go ahead and ask your question. Go ahead, unmute yourself.
Hi, yeah, so just a little comment about the last thing that he said about money going back into Bitcoin if people are investing in altcoins. So I question how that whole process works, because for one thing, all of these altcoins that trade against Bitcoin, the BTC to, umpteen thousands of altcoins pairs that are trading, this has been a huge use case for Bitcoin since the beginning, at least as big as the HODL use case. So, so I think it's, at least from my opinion, and I'm not an expert on markets, but it seems to me that even though, you could say, yeah, a lot of these coins are scams and people get, they lose money on it and stuff like that. But we also see through the bear and bull cycles that money flows back into Bitcoin from the altcoins. And then, it starts all over again the next bull run, right? But my point is, I think that the altcoins, have been as good for Bitcoin as they have been bad, perhaps. And the other thing I wonder is that is it true that the money goes, that if people, stop buying into altcoins, that money goes back into Bitcoin, and therefore that makes the price go up? Because the market set the price, right? Like people hodling doesn't necessarily, that only makes the price go up to the extent that it takes supply off the market, right? So Yeah, I don't see
but that's the whole thing, right? And so a couple things that you said. So first off, in 2016, 2017, you saw these kind of waves where Bitcoin would pump first and then altcoins would pump. And the reason why is kind of the point that you made, which was all the altcoins were denominated in Bitcoin. So you had to buy Bitcoin first, and then you can go trade your Bitcoin for the altcoins. So Bitcoin would pump first, and then altcoins would pump after that. But it doesn't really work like that anymore. Now you have all these other pairs, all these stablecoin pairs. You can wire fiat currency into most cryptocurrency exchanges now, exchange it for a currency or a stablecoin, and then trade. So I think that was kind of the way it was. It's not the way it is. But then back to the last part that you said, where it's good for Bitcoin. No, and you kind of summarized it at the end, which is supply and demand. And so the market sets the price. You said that, and you're correct. But the market sets the price based off supply and demand. And so with only 21 million Bitcoin, as more people want to own it, it just pushes the price up naturally. And so when I have other options, like 22,000 cryptos, then it takes away that demand. So I wouldn't say it's good for it.
Yeah, but you're assuming that there's no other option for people. There's another option. People don't have to buy Bitcoin at all. They can invest in stocks. They don't have to invest in crypto. So, it's like, for example, let's say there were no altcoins and everyone invested everything that they were interested in putting into crypto into Bitcoin. Well, Bitcoin can still go down. Right? Because people can put their money into other things. That's all I'm saying. And that the trading that goes on with the altcoins and Bitcoin, it's a use case. It's certainly more than people are using to spend Bitcoin. They're spending Bitcoin to buy these altcoins. And then, a lot of them lose. Most of them lose. Right? But it's still a use case. And I think that Bitcoin's current situation and the market cap has a lot to do with that. I don't know.
So you're certainly right. There's plenty of places to put your money. There's 6 or 7 main store of value asset categories. If you look at equities, currencies, real estate, bonds, and the total is about 700 offshore bank accounts. Total is about $700 trillion. If you add up just like the main store of value kind of buckets, 700 trillion. And so you're absolutely right. There's no shortage. But bonds, especially ones negative yielding, or real estate or equities, they're not trying to be the next Bitcoin, right? So it's not exactly the same. And you're right.
Yeah,
hey, I'm all for free. I'm a freedom maximalist. People are free to put their money wherever they want.
Okay, I just wanted to say that thing about they're not trying to be the next Bitcoin. That's like an old narrative from like 2017, in my opinion. A lot of the kind of fork coins that were like copies of Bitcoin. Okay, that makes sense to call that. But a lot of these other ones that are doing like smart contracts, and I'm not saying that just because they're doing smart contracts, it means that they're not a scam. There still are some that probably are. You could argue based on like, huge ICOs that they did that were, ridiculously large, things like that, right? But I think it's tough to call the ones that are doing smart contracts and they're not obvious.
How would you define a scam? How would you define that word? What's a scam?
It's not easy to answer that question. There's a lot of different ways.
It's super easy. If I sell you something but deliver you something else, that'd be a scam, right? I said, hey, I'm going to deliver you this thing, but I give you something else. Is that a scam?
Sure.
Okay. So if I tell you that this thing is decentralized and you buy it thinking it's just as decentralized as Bitcoin, but it's not, would that be a scam?
Yes, if you're saying that it is as decentralized as Bitcoin. But how many of them are actually saying that?
Well, all of them, right? Aren't they all trying to play this? Aren't they all trying to arbitrage off the trend of being decentralized?
No, I don't think
DeFi isn't, the D doesn't stand for decentralized.
Yes, but that doesn't say it's as decentralized as Bitcoin. There are lots of projects.
So now
there are lots of projects. What?
So it's decentralized-ish.
Of course, if you think the decentralization is a 1 or a 0, then you're kidding yourself. It's a spectrum. It's a spectrum. Something can be decentralized. Something can be even more decentralized. Even Bitcoin, right? When Bitcoin was primarily mined in China, it wasn't as decentralized as it is now. It improved.
So you could argue there's an escape velocity, but I believe you're either decentralized or you're not. So I don't agree with that. And what I would say back to the scam. So you start talking about smart contracts. Are smart contracts decentralized? How can they be? Because in order to rule on the contract, someone has to be an arbiter of truth, which requires an oracle. The oracle requires centralization. So all of a sudden, you're not decentralized now. Now, all these unsuspecting people.
No, you don't need it. You don't. No, that's not correct. You don't need an oracle to have smart contracts.
So who's the arbiter of truth to rule on the contract?
There's no arbiter of truth. It's chain code. It's code that runs on the blockchain. And
so give me an example. Give me an example of that.
Of what?
Of how smart contracts work without an arbiter of truth. Tell me how that works.
I'm not going to sit here and try to explain to you how Ethereum.
So I think there's maybe two interesting points here, right? So on the one hand, it's true that there are many oracles that are necessary in many different types of protocols. There are, however, many protocols that don't rely on oracles at all. Perhaps the most popular smart contract system in existence doesn't rely on oracles. That's Uniswap, which on many days does as much trade as Coinbase. And I think in that respect is actually quite an interesting achievement and something we should all, as Bitcoiners, be paying attention to. Sorry? Then with regards to the question mark of decentralization, I think, it's very hard to define things through a negative. Like, what is decentralization? What is freedom? These are negative terms, right? Centralization is when you have a central point, and then as you move away from that, you're more decentralized. But decentralization in and of itself was never what we wanted. We wanted the results of decentralization, right? We want things which are going to be censorship resistant. We want things which are going to be permissionless. We want things that are going to be able to stand up to state level attacks. And so I think the question that we need to focus on is which systems are able to do that. Now, to my mind, unquestionably, Bitcoin is the gold standard here. And I think that Bitcoin actually provides a nuclear umbrella to all of the others because people know, state-level attackers, for example, know they can't attack Bitcoin. And as a result, they don't attack the others either. Ironically, Bitcoin is sort of enhancing the immunity of Ethereum, for example, from state-level attacks. But it's also not clear, how, certainly we could imagine other systems that are built to be as focused on state-level attacks and censorship resistance and permissionless tooling as Bitcoin. And there are things like Tornado Cash where even in Ethereum, by the way, Tornado Cash, another example of something which doesn't require an oracle, which enhances privacy protection and censorship resistance. And even though the developers were arrested and, they were blacklisted by regulators around the world, people continue to use Tornado Cash to this day. And that's a very phenomenal proof of censorship resistance as well. So I think the binary approach of you're either decentralized or not is missing a lot of the functional properties that we're interested in terms of why we even want decentralization in the first place.
Okay. I don't know. We're kind of maxed out on time to kind of go down that rabbit hole, but I would agree with you, right? We don't want, my favorite marketing coach, Jay Abraham, says, nobody wants a drill. They want the hole, right? And so to your point, right, it wasn't necessarily decentralization. What we want is a system that nobody can control, right? We want to end seigniorage. We want to end the Cantillon effect, right? We don't want somebody to control the money and arbitrarily create more or censor it, et cetera, right? And so to your point, it's not decentralization. It's the results of that. So I would agree with that. As far as diving into every single protocol and trying to dissect them one by one, it's probably more than we can cover, for the rest of this time. But lots to unpack there.
If we're strapped for time, why don't we get a few more questions in before Mark has to leave?
Yeah, guys, feel free to submit a request to be a speaker. Sometimes I can't see if people request. So Yago, if you see any, please, if you could accept them, that'd be great. This app can be a little bit buggy. We will continue from there. Okay. All right. So guys, if anyone wants to make their closing statements while people, we do have one coming in here. Okay. TradFi to DeFi.
Hey guys, thanks for having me on the call. We actually recently featured David on our podcast. Would love for people to take a look at it if they want to hear more about his article. Actually, the question was more for David, actually. I was wondering if you could talk a little bit about credit creation with Bitcoin collateral and how that, we've seen stable coins blow up. What are some of the risks posed to creating credit backed by Bitcoin, and how is that like a better future based on, having a more pristine collateral type as opposed to just bizarre perpetual motion machines like Terra Luna?
Sure. Well, I think to start, I think people bring up a very astute point that there is an insatiable desire to want to create credit money, whether we think it's good or bad. I think many Austrians and kind of people in the Bitcoin economy will say, hey, we don't want credit money. It is the source of all evil. And while I sympathize with that point, for the past like 5,000 years, like people will find a way to create credit. And I think now that we are able to issue credit on chain, we can bring in Bitcoin collateral into a smart contract, and then we can mint credit or stable coins against that. So it's just an over collateralized stable coin. You put in, say, $1 million of Bitcoin collateral or any arbitrary amount that you want, smaller, larger, whatever. And then you can mint, say, $500,000 of Bitcoin backed stable coins. The key to this is that as long as the system always stays over collateralized, where there's more dollar value of Bitcoin backing the amount of liabilities or stablecoins that have minted, then the peg maintains itself. And so this is really much more compatible with the Austrians' view of what they call commodity credit versus circulation credit. And Mark had mentioned this a little bit earlier, but commodity credit is where there's more savings, or in this case, Bitcoin collateral, than there is actual liabilities that have been minted. And so that is a very compatible idea with the kind of ethos that many Bitcoiners have. And so I think in the future, we'll kind of see this naturally play out. And I think as more Bitcoiners learn about it, they'll say, okay, actually, that's like not too bad. An over-collateralized stablecoin that doesn't create fractional reserve or more kind of circulation credit is something that they support.
And then I think the other thing that I think is really cool about that too, and you've mentioned this in some of your writing as well, that you also can actually bring about more of a Bitcoin standard with a speculative attack, because this newly issued credit is denominated in dollars, right? And therefore, you're essentially shorting the dollar.
Yeah, and maybe I can loop Mark in here, because he has some great perspectives on this kind of macro view as to how he sees the world playing out. And I think long term, a lot of us kind of see Bitcoin as this great store of value, this kind of inflationary decade coming about. And so I think a lot of people are going to say, how can I hold my Bitcoin as long as possible, not sell it, but also still extract dollars out of it and avoid a tax penalty? And so I see this world where eventually, the fiscal authority side of the U.S. is going to have to start issuing, tons more of bonds or T-bills into the economy to fund kind of just random activities, maybe energy infrastructure, maybe this kind of deglobalization, and it's going to cause more monetary inflation. And if they can't raise rates because the debt levels are so high, they're going to tax people. And so Bitcoin really over the next decade, is an even better investment than most people think. One, because it avoids this kind of potential monetary debasement, but it also avoids the taxation, which governments will use as a way to try to quell the inflation. So if you have a way to borrow against your Bitcoin at 0% or a very, very tiny interest rate, extract dollars and avoid the taxation, while this kind of deglobalization and demographics bomb and all of this stuff plays out, we're sitting very pretty. And that's not possible unless you also decentralize, and I put decentralize in quotes, these kind of credit creation layers. So simply having, Bitcoin, the asset, as this decentralized pure asset is not enough. And if we don't also have these kind of these monetary or credit layers that we can use outside of a centralized custodian, then we're really going to relegate Bitcoin to gold 2.0 in all the worst ways.
That's awesome. Thanks so much for answering my question.
I mean, to kind of just to add a little bit of color into that, and this is really something that I borrow from Jeff Booth. And Jeff Booth talks about you're not able to see the new system when you're inside of an existing system. And so what happens is, as humans, humans are no good. We're horrible at imagining the future. So what we can do is we can imagine new versions of what we have today, but we can't imagine new things. So for example, we have cars. One day we'll have flying cars, right? So we take what we know and we extrapolate to something new or improved. When steel came out, they're like, oh, this is a harder material. We could build taller buildings or bridges now. We didn't know that one day we'd have space shuttles because we had steel, right? And so I think that's like a good extrapolation of what the financial system could look like based off of what we know it as today. But I'm not exactly sure that's what it looks like. And at some point in the future, when we get to a Bitcoin standard, because we live in a debt-based monetary system. And because we live in a debt-based monetary system, the best way to get rich is with debt, right? And so you want to take on lots and lots of debt. The other thing is because we are in a debt-based monetary system, an inflationary monetary system where our money continues to lose value, then we're forced to get rid of our money and try to earn yield. Right. So now we're trying to buy real estate because we can make 4 or 5% on it, or we're going to buy this bond or the stock. And so we're forced to try to think about yield. And so we're always thinking in those terms. And so kind of thinking about that financial system, he's talking about, well, we have the Bitcoin, but we don't want to sell the Bitcoin. And what do we do to avoid taxes? And we want to earn yield. And that's all kind of a symptom of the system that we're in today. But imagine if we will, and again, humans are no good at this. So none of us are good at this, but Jeff Booth might be better. But imagine in a newer system, where we weren't on a debt-based system, where our money wasn't losing value, where our money bought us more goods and services in the future instead of less, right? And so in that type of environment, I'm not trying to get rid of my currency as fast as I can. I'm not trying to earn yield on it as fast as I can. I want to hold it. I want to hold it because it's going to buy me more goods and services in the future. And so I think this entire financial system, this financial construct that we have today doesn't necessarily lend itself to the future. Most of it goes away. I mean, think about the entire Wall Street complex. The entire financial complex is designed to help the average person survive through inflation. But if we don't have inflation, it all goes away. We don't need any of that. Now, back to the Mises kind of point that I brought up earlier and you referenced, which is the difference of circulation credit versus commodity credit, is that circulation credit versus commodity credit is the difference of delayed gratification. And so all wealth should be created, it should be saved. We should consume less than we produce. So we save. And then instead of consuming that savings today, I could decide to delay that and I could lend it to you. But instead of me using it, now I'm allowing you to use it. So I grow bushels of wheat. I'm going to let you take this bushel of wheat here on credit. But that credit is actually delayed gratification on my part, as opposed to creating new currency units, which expands the monetary system. So I don't know. I don't have an answer. The answer, I believe, is that humans are no good at imagining the future. When the internet came out, we saw message boards and shopping online. We didn't know that our cars would be hooked to something called a cloud, using something called social media to navigate us around traffic, because we didn't have that. And so I don't think any of us know exactly what the new financial system looks like, but I think it doesn't look like a different version of what we have today.
Yeah, that makes sense. I just briefly want to reply to that. I think, if we all believe Jeff Booth's thesis, which I think we do, is that technology is deflationary, and so that the purchasing power of Bitcoin will perpetually go up, then that does in fact mean that you want to hold your Bitcoin as your store of value as long as you can. And so I think borrowing against it so that you don't have to is not incompatible. It's actually hyper compatible with Jeff Booth's thesis. And so I think people should kind of contemplate that, is like, how will the game theory play out? Like if technology is deflationary, Bitcoin purchasing power goes up, you don't want to sell it, you borrow against it, like that game theory will naturally play out. And then I also, want to propose just like, a simple scenario where, if I lend 1 Bitcoin to Mark for 1 year, what I receive in return is some sort of IOU, whether it's a handshake or a paper agreement or some sort of promise. It's something that I receive that is minted out of thin air as a result of that arrangement. And some people would say, well, that doesn't change the 21 million. I gave my 1 Bitcoin to Mark. There's still 21 million out there. But as soon as we create that IOU, I could take that and I could sell that IOU to Yago on the secondary market. And I could say, hey, Yago, Mark's going to pay you in 11 months. 1 month has gone by. As soon as we make that transaction where any Bitcoin is loaned out, we are creating credit money. And so this is the point I just want to hammer home to kind of like, some people in the Bitcoin community is that credit money is unavoidable. It is impossible to completely eliminate. And so we have to embrace this kind of world where we acknowledge that Bitcoin can be the core monetary unit and we could have tons of other layers of credit money on top of it. But we can't just say Bitcoin 21 million P2P, because you just can't eliminate that human incentive that somebody is willing to kind of lend out one of those units, and as a byproduct, because of the secondary market, a new monetary unit is created. And so this is just like a reality that we can't avoid. Anyways, I don't expect Mark to have a reply to that, but I just wanted to make sure I mention it because I think it's relevant.
All right, guys, thanks so much. Mark, did you have anything to add? Anyone else want to have any closing statements before we close out here?
I mean, the closing statement would be just to kind of reiterate, like I've already done, which is kind of the point of this conversation. You know, I'm not an advocate of regulations. I think all regulations should be done away with. We don't need the SEC to protect us. However, that's not the case. The governments want to regulate things more and more and more. They want to control all forms of money, and so I think more regulations are coming. I think it affects cryptocurrency, and I don't think we see another cryptocurrency bull run. I think it's bullish for Bitcoin. It's not a smooth road, as we've discussed. There's lots of attack vectors on Bitcoin as well. For now, I don't see that as a big threat. And so I think it's bullish for Bitcoin. And I'm bullish on Bitcoin, even more bullish on Bitcoin, one, partly because of that, also because, you know, I think Bitcoin is transitioning into what would be considered a risk-off asset. And I think, you know, in the past, it's traded like a tech stock, like a risk-on asset. But I think it's transitioning into a risk-off asset. And in this environment that we're going into, and more of a what I call a decentralized revolution, the world decentralizing, breaking down into multipolar world, is also bullish for Bitcoin. And so, no surprise, I'm a Bitcoin bull.
Well, I really enjoyed this conversation. I think, Mark, you know, you've made some really strong points, and you make your points very well, right? So initially, your argument that we wouldn't see you know, this is the last crypto bull market. I think you made the point very well, and I'm sure it will eventually prove to be the case. I am somewhat saddened by the fact that I wish it was true, but I don't think it is. And you know, I just say that on the basis of the fact that the combination of regulatory arbitrage, greed, over optimism, hype cycles, I don't think those are behind us. And thankfully, I think it is a very upsetting distraction, but only a distraction. You know, I'm sure Mark and almost everyone else on this call has a feeling similar to that I have, right? Which is that we're engaged in something that we believe in, that we think is deeply important, and we constantly find ourselves married to these bad actors, these scammers, these poorly thought out projects, and make it more difficult for us to be able to A, want to be associated with any of this, and B, present the truth, the opportunity that we have available to us. I do think that Bitcoin is uniquely positioned in that Bitcoin, because it emerged and has developed such a strong culture of wanting to create a different world rather than wanting to create new technologies or new opportunities for sick gains. The Bitcoin community is particularly well positioned to create that new future. And for us to do that, we need to be on the offensive. We need to be thinking, how do we build a world built on Bitcoin? What does it look like? The last point that Mark made was also very well made, right? And, you described, Mark, the difficulty in imagining what the future looks like. And I think ultimately that responsibility to imagine and invent that future falls to us. Because if we don't do it, somebody else is. And you're right, it will end up looking like a flying car or a flying pig, right? So, you know, I think in many ways, the disappointing thing to me about this conversation is we hinted at, but didn't really get into what I think is the most interesting thing, which is, what does that future look like? What does a world built on Bitcoin look like? What are the systems that we're going to need to get there? And what would it look like once we're there? We started touching on it towards the end of the call.
And so, Mark, I'd be really interested to hear your thoughts on that, and maybe we can organize an additional conversation in the new year to discuss the future.
All right. Yeah.
Sorry,
perhaps,
I was on mute there. Yeah, Yago, I would love to. Why don't we set up another meeting? It's probably a little bit longer than I want to go right now, but always happy to come back and discuss that, and we can talk about that. I think it would be great. Future casting, right? Taking a guess.
Absolutely.
All right, part 2 is in order, gentlemen. Yeah, thank you very much, everyone, for joining. Guys, thank you, Edan Yago, David Seroy, Mark Moss, all of whom are sovereign thinkers. Follow all of them. Thanks again, guys, and stay sovereign. Cheers.
Thanks so much.
Closing out.